This video breaks down the 5 things you absolutely need before you set up any business retirement account. The structural realities that determine whether your plan becomes a financial asset or a financial liability. Let's get into it. You finally decided to set up a retirement account for your business. You Googled it once, and now your search history looks like a financial alphabet soup. SEP, simple, 401k, profit sharing, safe harbor. It feels like the IRS handed you a menu written in Latin, and every option comes with a side of paperwork. You're not alone. Most business owners get to this point and either pick the plan their friend uses or they freeze and do nothing. Both are expensive mistakes. Pick the wrong plan, and you're either leaving serious tax advantages on the table or you're signing up for a compliance headache that will follow you for years. And if you think you can just set it and forget it, I have some bad news about what happens when the IRS or the Department of Labor starts asking questions. This video breaks down the 5 things you absolutely need before you set up any business retirement account. Just the structural realities that determine whether your plan becomes a financial asset or a financial liability. Before you worry about costs, compliance, or what happens when an employee quits, you need to know what you're actually ordering from the menu. Think of retirement plans like cars. A SEP IRA is a Honda Civic. Reliable, simple, gets you from A to B. A solo 401k is a 2-seater sports car. Fast, powerful, but useless if you have passengers. A full traditional 401k with profit sharing, that's the fleet vehicle. More moving parts, higher maintenance, but it can carry your entire company. The problem is most business owners walk into a dealership and ask for a car. That's not a strategy, that's a guess. Let me break down the real options here. A solo 401k is designed for businesses with no employees, other than you and possibly your spouse. It offers the highest contribution limits for self-employed individuals, and you can contribute as both the employer and the employee. But the moment you hire someone who isn't your spouse, this plan starts to break down. You can't just keep driving the 2-seater once you have a team. An SEP IRA is the go-to for many small business owners because it's easy to set up and has higher contribution limits. But here's the catch that nobody talks about at the dinner table. If you contribute for yourself, you have to contribute the same percentage for every eligible employee. If you give yourself 20% of your compensation, you give everyone else 20% of theirs. That generosity adds up fast. And for some business owners, it turns the SEP from a tax shelter into a payroll explosion. A simple IRA sits in the middle. It's designed for businesses with 100 or fewer employees. Lower contribution limits than a 401k, but far less administrative headaches. Both you and your employee contribute, and the employer matches either 2% non-elective or 3% matching. It's the practical middle ground. But practical also means limited. If you want to maximize your personal retirement savings as the owner, the simple might cap you lower than you'd like. Then there's the traditional 401k. This is the full feathered option. Employee deferrals, employer matching, profit sharing add-ons, safe harbor provisions to avoid compliance testing nightmares. It is the most flexible and the most powerful. It is also the most complex. Running a traditional 401k is not a do-it-yourself weekend project. It requires a third-party administrator, regular compliance testing, Form 5500 filings, and a fiduciary responsibility that you cannot outsource entirely. And finally, the defined benefit plan. This is the pension-style option. If you are a high-income professional, think physician, attorney, consultant, and you want to stock away $200,000 or more per year in a tax-deferred structure, this is your vehicle. But it requires actuarial calculations, mandatory annual funding, and a long-term commitment. It is not for the faint of heart, and it is definitely not for a business with volatile cash flow. So how do you choose? You do not start with the plan, you start with the business. How many employees do you have now? How many do you plan to hire in the next 3 years? What is your personal income, and how much of it do you want to defer? Are you trying to maximize your own retirement, or are you trying to build a competitive benefits package to attract talent? If you are a solo operator who loves simplicity, a solo 401k or SEP probably fits. If you have a handful of employees and want something manageable without a full-blown benefit manager, the simple IRA is worth a hard look. If you are building a scalable company with growth ambitions, or you want to maximize your personal contributions while offering a legitimate benefit to your team, you are probably heading toward a traditional 401k with safe harbor provisions. If you are a high earner in your 50s looking to catch up aggressively before retirement, the defined benefit plan might be the only tool that gets you where you need to go. The plan type is not just a tax decision. It is a structural decision. It affects your cash flow, your payroll, your hiring flexibility, and your personal financial trajectory. Choose the wrong vehicle for your business model, and you will spend the next few years either overpaying for complexity you do not need, underpowering your retirement because you outgrew the plan too fast. Speaking of costs, let's talk about the price tag, because low fee does not always mean low cost, and no fee sometimes means you are the product. Imagine you are buying a house. The listing price looks good. Then you find out about the property taxes, the HOA fees, the maintenance reserve, and the special assessment for the new roof. The sticker price was just the opening act. Retirement plans work the same way. There are costs you see, and there are costs you do not see until you are already committed. Let's start with the visible ones. Setup fees, annual administration fees, record-keeping fees, compliance testing fees, Form 5500 preparation fees, investment management fees, and then the fees inside the investments themselves. Solo 401k at a discount brokerage might cost you nothing to set up and $50 a year to maintain. A SEP IRA might cost even less. But a traditional 401k for a small business, we're typically looking at $1,000 to $3,000 annually in base administrative costs. Add safe harbor provisions, profit sharing allocation, and custom plan design, and the number climbs. Now here is where business owners get into trouble. They see a provider advertising free 401k setup or zero administrative fees, and they think they have found a deal. But free at the front end often means expensive at the back end. Those providers frequently make their money on high expense investment options, revenue sharing arrangements, or advisory fees buried inside the fund lineups. You think you are paying nothing. Your employees think they are paying nothing, but the plan is leaking value every single quarter through investment costs that are 50% to 100% higher than what you would pay elsewhere. And here's the part that should keep you up at night. As the plan sponsor, you have a fiduciary duty to ensure that fees are reasonable for the services provided. That is not my opinion, that is ERISA law. If your plan is loaded with expensive funds because you did not shop the investment lineup and a participant sues or the Department of Labor audits you, I didn't know is not a defense. So what should you do? You demand transparency. Ask every prospective provider for a complete fee schedule in writing, not just the administrative costs, the investment expense ratios, the advisory fees, the revenue sharing arrangements, any hidden charges for distributions, loans, or plan amendments. Then benchmark it. Get 2 or 3 quotes. Look at what similar plans in your industry are paying. If one provider is dramatically cheaper, ask why. If one provider is dramatically more expensive, ask what you are getting for that premium. Another cost most owners ignore: their own time. A cheap plan that requires 10 hours a month of your personal attention is not cheap. It is just expensive in a different currency. Your time is worth something. If a slightly higher administrative fee buys you a third-party administrator who handles compliance testing, participant questions, and government filings, that might be the best return on investment in the entire plan. Finally, think about the cost of getting it wrong. A failed compliance test means corrective distributions, refunds, paperwork, and possibly penalties. A late Form 5500 filing carries automatic IRS penalties that start at $250 per day. A Department of Labor audit triggered by participant complaints can cost tens of thousands in legal fees. Even if you did nothing wrong, the cost of prevention is always lower than the cost of cleanup. So when you evaluate plan costs, look at the total cost of ownership, not just the invoice from your provider, the investment fees, your time, the compliance risk, and the potential cost of errors. That is the real price tag. Now that we have covered the plan costs, let's talk about who actually owns what inside, because employer money and employee money are not the same thing. Think of your retirement plan like a shared office building. You, the employer, own the lobby, the elevators, the structure itself. That is the plan document, the compliance framework, the fiduciary responsibility. But every participant has their own office inside that building. Their deferrals, their accounts, their vested balances. You maintain the building. You do not own what is in their offices. This distinction matters more than most business owners realize. When employees contribute to a 401k, that money is theirs immediately. It is their deferral, their salary reduction, their property. You cannot touch it. You cannot delay it. You cannot borrow from it. Your responsibility is to deposit it into the plan on time, typically as soon as administratively feasible, which for most plans means within a few business days of payroll. Miss that window, and you committed a prohibited transaction. The Department of Labor does not issue warnings for this. They issue penalties. Now, employer contributions are a different story. Matching contributions, profit-sharing contributions, non-elective contributions, these are subject to vesting schedules. You can design a plan where employer contributions vest immediately or over a graded schedule, or all at once after a certain number of years. That vesting schedule is a retention tool. It is also a legal contract. Once the money vests, it belongs to the employee. Before it vests, it belongs to the plan, but you still have to track it with precision. Here's where employers get sloppy. They commingle funds. They delay depositing employee deferrals because cash flow is tight. They change vesting schedules without amending the plan document properly. They fail to notify participants of their rights. Each of these is a violation of ERISA fiduciary standards, and each one exposes you personally to liability. Yes, personal. If you are the business owner, the plan sponsor, the fiduciary liability generally attaches to you as an individual, not just your business. Your personal assets can be at risk in a lawsuit or government enforcement action. This is not a scare tactic. This is the structure of ERISA. So what does this mean practically? It means you need clean accounting. Employee deferrals must be tracked separately from employer contributions. Vesting schedules must be applied consistently and documented. Participant statements must be accurate. And if you ever have to correct an error, say you missed a deposit or you miscalculated a match, you need to fix it through the proper correction programs, not by quietly adjusting the next payroll. You also need to understand that your role as fiduciary does not end when you hire a third-party administrator. Outsourcing administration does not outsource fiduciary responsibility. You are still responsible for selecting and monitoring the plan's investments. You are still responsible for ensuring fees are reasonable. You are still responsible for making sure the plan operates according to its own documents. The administrator is your vendor, not your legal shield. Treat employer accounts and employee accounts with the same separateness you would treat your business checking account and your personal checking account. The IRS and the Department of Labor certainly do. Speaking of responsibility, let's talk about the rule book, because having a plan document and following it are two very different things, and the gap between them is where most compliance problems live. Imagine you buy a high-performance sports car. It is beautiful, it is fast, but it comes with a 200-page owner's manual. Now imagine you toss the manual in the trunk, never read it, and then act surprised when the engine seizes because you skipped the maintenance schedule. Your plan document is the owner's manual. It is not a suggestion. It is a legal contract between you, the plan sponsor, and every participant in the plan. And compliance means operating the plan exactly as the document says, exactly as the law requires, exactly when the deadlines hit. Let's start with the basics. Every qualified retirement plan must have a written plan document. That document defines who is eligible to participate, when they enter the plan, how contributions are calculated, what the vesting schedule is, and what happens when the plan ends. If your actual practice deviates from the document, you are out of compliance. Even if the deviation benefits employees, even if nobody complains, even if you did not know. Then there are the annual compliance tests. Non-discrimination testing, stop-heavy testing, coverage testing. These are mathematical formulas designed to ensure your plan does not disproportionately favor highly compensated employees or business owners. If your plan fails these tests, you must make corrected distributions or additional contributions, usually by specific deadlines. Form 5500 is the annual report you file with the Department of Labor and the IRS. It discloses plan finances, participant counts, and compliance status. Large plans need an independent audit attached. Small plans can sometimes avoid the audit, but they will need accurate financial reporting. Filing late, filing incorrectly, or failing to file at all triggers penalties that escalate quickly. And then there are participant notices, summary plan descriptions, summary annual reports, fee disclosures, automatic enrollment notices. These are not optional courtesies. They are legal requirements with specific content rules and delivery deadlines. Fail to provide them, and you have a compliance violation even if the plan itself is otherwise perfect. Here is the uncomfortable truth most business owners do not want to hear. Compliance is not a one-time event. It is an ongoing operational discipline. You need a compliance calendar. You need someone, whether internal or external, who owns the deadlines. You need to review your plan document periodically to make sure it matches how you actually are running the plan. Laws change. Your business changes. The plan document needs to keep up. Some owners try to handle this themselves with spreadsheets and reminders. Others hire third-party administrators who specialize in plan compliance. Either approach is wrong, but both require active oversight. A TPA can only work with the information you give them. If you do not tell them about a new employee, a compensation change, or a plan amendment, they cannot magically keep you in compliance. And if you think you can just rely on your payroll provider to handle everything, think again. Most payroll companies process contributions. They do not serve as fiduciary. They do not run non-discrimination testing. They do not sign your Form 5500. They execute transactions. You retain the responsibility for whether those transactions were correct. Authoritative compliance means you treat the plan like the legal entity it is. You read the document, you follow the rules, you meet the deadlines, and when something changes, you amend the plan properly rather than improvising. It is not exciting, but it is what keeps you out of court, out of audit trouble, and out of the penalty box. Let's talk about endings. Because businesses change, employees leave. Sometimes the plan itself needs to end. And if you don't know how to manage that transition, you are setting yourself up for a logistical and legal nightmare. Every business owner loves to think about growth. Nobody loves to think about offboarding. But retirement plans force you to think about exits. When an employee leaves your company, the retirement account does not automatically dissolve. It stays in your plan until they roll it over to an IRA, roll it into a new employer's plan, or take a distribution. But while it sits there, you're still responsible for it. You still have to provide statements. You still have to maintain records. You still have to ensure the investments are appropriate. A plan full of former employees with small orphaned balances becomes an administrative anchor. So what should your process look like? First, you need a clear termination procedure written in your plan document. When employment ends, the participant needs to know their options, their deadlines, and any fees associated with distributions or rollovers. You need to provide this information promptly and document that you provided it. Second, you need to decide your policy on cash-out distributions for small balances. Federal law allows plans to automatically cash out balances below $1,000 if the participant does not respond. Between $1,000 and $7,000, you may be able to roll these balances into an IRA unless the participant elects otherwise. These are default rules, but your plan document specifies exactly how you handle them. If your document says one thing and you do another, this is a compliance failure. Third, you need to track outstanding loans. If a departing employee has an unpaid plan loan, the remaining balance typically becomes a taxable distribution unless they repay it quickly or roll it over. You need to issue the correct tax forms. You need to report the distribution properly. You need to withhold the appropriate taxes if it's a taxable event. Loan defaults in retirement plans are surprisingly common, and they create tax chaos for former employees if you do not handle the paperwork correctly. Now, what if you close the plan entirely? Maybe you're selling the business. Maybe you have decided to switch to a different plan type. Terminating a qualified plan is not as simple as calling your provider and saying you are done. You must follow the plan document's termination provisions. You must fully vest all participants at termination. This is not optional. You must distribute all assets within a reasonable time frame, typically defined as 1 year from termination. You must file a final Form 5500. You must provide participants with notices about their distribution options and the consequences of each one. And if the plan has ever been less than fully funded, or if there are outstanding compliance issues, those need to be resolved before you can legally terminate. Some owners try to terminate a plan to escape compliance problems. That does not work. The IRS and the Department of Labor can still audit a terminated plan, and they frequently do. Address the underlying problems first. Clean up the testing failures. Reconcile the participant accounts. Then terminate from a position of compliance, not from a position of panic. The exit strategy also applies to you as the owner. If you are the primary participant in a solo 401k and you close the business or bring on employees, your plan needs to evolve or terminate. You cannot keep a solo 401k once you have non-owner employees. You need to either convert to a different plan type or wind down the old plan properly. Ignoring this transition does not make it go away. It just makes the eventual correction more expensive. Your retirement plan needs an entry strategy and an exit strategy. You need to know how participants get in, how they get out, and how the plan itself gets wound down if necessary. Build those procedures before you need them, because the day you need an exit strategy is not the day you want to be reading the plan document for the first time. So there it is. Plan types, total costs, the employer-employee split, compliance discipline, and your exit strategy. Get these 5 right, and your plan becomes a genuine financial asset. Get them wrong, and you have built yourself a liability dressed up as a benefit. In our next video, we're going to talk about required minimum distributions for retirement accounts. I want to thank you for watching, and go build something that lasts.